You'll
Yeah.
remember back in 2023 when Kitco viewers were experiencing frustration, given that the gold price was up, but the gold mining shares weren't up.
Hmm.
That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down. In past bull markets, it has taken a while for the increase in the gold price to follow through to generate increased free cash flow among the gold miners. And that happened in 2024 in spades, and it's happening in 2025 in spades.
Hmm.
What that means is that the prices of the gold miners, as an example, Wheaton Precious Metals, who was an exhibitor, Agnico Eagle, who was an exhibitor, those companies are up in the last 18 months uniformly 100 to 150%.
Hmm.
And it's follow through, I think, gold to the gold shares that attracted our attendees. The thesis is proven. They don't now have to feel like they have to wait for a gold bull market. They understand that they're in a precious metals bull market and that they're in it right now.
Yeah, yeah. And gold's, I mean, still above that 3,300. We saw that little bit of a dip, and of course, everyone bought the dip, and miners finally seem to be waking up. I mean, Newmont, I think you saw, Rick. I mean, beat across the board. You mentioned Agnico's margins; they're remaining strong. Even juniors are starting to get a bid, like Dakota. Are we finally starting to see that disconnect close? I know that you brought it about central banks, but it almost feels like these hard assets are starting to companies are starting to catch the bid.
I think that's true. And you mentioned
Yeah,
the Newmont quarter. I mean, that blew out everybody's
yeah,
earnings estimates, including my own.
yeah,
And frankly, it blew out Newmont's own
yeah.
estimates.
Yeah.
What Newmont did, and we talked about this, Jeremy, you and I, a year ago.
Mhm.
Newmont had prior to this quarter 8 bad quarters in terms of sustaining cost performance. What Newmont did is they sold off virtually all of their second tier assets. By the way, raising almost $5 billion in the process.
Mm.
But the other thing they did is free up management time and attention and sustaining capital to focus on their tier one projects. And the operating cost performance was absolutely spectacular. In addition to that, they added almost $5 billion in cash to the balance sheet.
Yeah.
They can deploy some of this for sustaining capital, but they can also give some back to shareholders, which they've elected to do. They've decided that they're going to buy in stock, returning cash to shareholders by reducing the float. Spectacular result,
Yeah.
and that has that's the wealth has been spread around.
Mhm.
With people like Dakota, the market is looking at the Barracks of the world, at the Newmonts of the world, and saying, what are they going to do with all this money? What are they going to do with all this high share price? How are they going to maintain their growth? Maybe they're going to buy something like Dakota.
Yeah. There's been a lot of chatter about M&A, but aside from, those few bolt-ons, the majors haven't acted too aggressively here. I mean, is it the calm before the storm, maybe an inventory supply problem, or is the industry still kind of paralyzed by 2011's PTSD?
I would suspect both of those. That's a great comment. For the viewers who aren't familiar with this statistic, in the period 2000 to 2010, when the gold price went up sevenfold, the free cash flow per share of the gold miners actually declined.
Hmm.
It was a decade of ridiculous malinvestment of capital. The management teams that presided over that dismal performance, pardon me, have been thanked and excused. But the institutional investors and the management teams themselves have kept the mining companies on a very tight leash with regards to capital deployment. My suspicion is that as the metrics around gold companies' valuations increase in a bull market, and as investor concern about companies' ability to maintain or grow their production increases, then you will see increased investment activity, including increased merger and acquisition activity. So I think what you describe as the calm before the storm is
Yeah.
completely accurate, Jamie.
Okay, let's
Jeremy.
get into what we're buying here. Names. I mean, what specific companies are you kind of accumulating right now? And let's just talk briefly about why before we kind of give more into the macro side.
I've asked most of my attendees to focus on the best names,
Yeah.
the best of the best, the Agnicos of the world, the Francos, the Wheatons, give you surprising performance in a gold bull market with almost no operational risk. For myself, I bought those names 4 years ago and 5 years ago, so I don't have to buy them now. What I'm doing now is coming down the quality trail, looking for big big single mine companies that would make attractive bolt-on acquisitions and ones that are cheap. I need to mention too, Jeremy, that I'm much more willing than most to accept political risk.
Yeah.
So names like West African Resources in Africa, Endeavour Mining in Africa are appealing to me because I'm willing to take political risk and because they're extremely cheap by any metric. I personally, too, am going down into the exploration space because I like to be involved in markets where I don't have much company and very much competition. I wouldn't expect the bull market to expand into the exploration space per se for 18 to 24 months, but I like to be in space before the competition is.
Yeah, interesting you say that. I mean, we were talking to Robert Kaplan. I know you know him well, and I was surprised by the interview. He was saying that jurisdictions become one of the top things that he's looking at now. I mean, that is jurisdictional risk kind of priced in, or is it underpriced now in the market?
Tom and I would argue about this.
Yeah, yeah,
I think that jurisdictional, well, let me rephrase it. I don't think there are any good jurisdictions.
right.
The worst experience with political risk I've ever had in my life is the People's Republic of California,
Hmm.
which is regarded as a low risk jurisdiction. The best jurisdictions in my life have been Western Australia and Chile. Chile is getting a little worse as it gets richer. They can afford to be stupid. I think all jurisdictions are lousy. I think the government that's the most dangerous is the government that's closest to you.
Yeah,
But there are certain jurisdictions where companies enjoy a lower cost of capital in accordance with a beauty contest. The Fraser Institute in Vancouver publishes a sentiment list around political risk. They
hmm,
would describe Saskatchewan, Canada, as the lowest risk jurisdiction on the planet, but they give both Quebec and Ontario fairly high marks. They give certain American jurisdictions, Alaska, Wyoming, Nevada,
hmm.
fairly high regard. They're a little tougher on most other jurisdictions. In my own life, Jeremy, what I've learned is that I try to avoid technical risk. In other words, I try to buy good deposits and I grit my teeth with regards to locations. But I
Yeah.
understand that I'm more tolerant of political risk than others.